And I want to welcome you all watching In Your Interest here on News 9 Live. I am Krishna Kumar, and the big story that we're tracking on the show is the inflation in India, as inflation comes down below the 4% mark for the first time in nearly half a decade. The big question is, will the Reserve Bank of India cut interest rates? And if that's going to be the case, is it the right time and probably the last opportunity for you to make your investments into fixed deposits at the current high rates in which they're being offered by banks? After staying above the 4% mark for nearly 5 years, retail inflation in India has finally dipped below that crucial level. It has hit a 59-month low of 3.54% in the month of July 2024. This drop, however, is mainly due to a high base effect, according to data from the National Statistical Office, or NSO. Now, the last time we saw retail inflation below 4% was back in September 2019. Meanwhile, food inflation also dropped to a 13-month low of 5.42% in July from 9.36% in the month of June. Over the past 8 months, food inflation has hovered anywhere between the 8 to 9% mark due to the high prices of vegetables, cereals, and pulses. However, on a month-on-month basis, the Consumer Price Index, or CPI, which retail inflation is based on, gained momentum in categories like food, clothing, housing, and of course, the overall index value. So where exactly is inflation headed from here on? And if inflation is going to continue to cool, will RBI look at cutting interest rates? We have Teresa John, Deputy Head of Research, Nirmal Bang, and lead economist as well, joining us on this broadcast here on In Your Interest. Teresa, thank you so much for taking time to be with us here on the show. Simple question to you. Do you see inflation remaining below that 4% mark going forward?
So over the next 2 months, so probably August, also you could have inflation around 4%, but and probably September also could be relatively low. But from October onwards, we expect inflation to pick up back again, which is what the RBI has also been saying, that the soft patch of inflation that we got yesterday and which we probably will have over the next 1 or 2 months is a blip, because last year we had this huge spike in vegetable prices, which happened in July 2023. Particularly, tomato prices had gone through the roof, but not just tomato prices; all vegetable prices had gone up. So it's not that vegetable prices have come down, but on a high base, the prices look relatively low. So largely, the number that we saw yesterday was because of a high base of last year. And as you were also pointing out, so vegetable inflation has come down from around 29% to around 6%, but on a month-on-month basis, it's still gone up around 14 to 15%.
Okay. The reason why I'm asking this question is that when you talk about inflation, the first thought goes to food inflation, because that is outside the realm of control of anybody and anything. And food inflation, if you see, hasn't exactly come off completely. Again, it is lower than the highs it has hit, but it's still not in a range where you can expect it to be remaining low for the foreseeable future.
Right. So it is food inflation. It cannot be controlled by interest rates. You're absolutely right on that. Actually, even the economic survey was highlighting the point that core inflation has been low over the last couple of months, and food inflation is not within the RBI's control. So should the RBI keep interest rates high purely on account of high food inflation? But the governor clarified very lucidly on that point in the last monetary policy last Thursday. So the key point that he wanted to convey was that food inflation is what shapes inflation expectations, and you could potentially have a wage price spiral, because if people kind of internalize the fact that inflation is high because of food inflation, they will go and negotiate for higher wages, and that can lead to a wage price spiral. And also, apart from that, as a result of that, you could see food inflation actually spilling over into core inflation, potentially with a lag. Thankfully, over the last 1 year, we have not seen that happen, but that still remains a risk. So RBI still remains focused on the headline inflation number, not on the core inflation number. But that's it. The headline inflation number has come up, but as I highlighted earlier, this seems a blip more because of high base of last year, not something that will sustain for an extended period of time.
Okay, okay, more of a case of a high base effect. So, apart from food, there is also you have clothing, housing, also prices also rising along with it. Even within food, for example, pulses, the inflation continues to be in the double-digit mark. But talk to us outside of food, other commodities getting expensive.
That's right. So mainly this month we saw the telecom tariff hike. So that was the main impact on core. So we've seen core inflation actually gone up from 3.1% to around 3.5%, mainly because of the telecom tariff hike. So telecom tariffs actually hiked by around 15 to 20%. The CPI increase is only around 8%. Clothing inflation has remained high. It's still going up on a month-on-month basis, but cotton prices have come off. So since the large part of your clothing inflation is actually influenced by cotton prices, probably we will not see that high inflation in clothing going forward. That said, on a month-on-month basis, it's still going up. Yeah, and it's not just pulses is there, and you even have cereals which have gone up, oils and fats, which are like your palm oil, etc. Over the last 1 year, or maybe 1.5 years, we've seen deflation. But again, on a month-on-month basis, it has started to go up. So it's the food basket as a whole remains quite challenging. Probably the Kharif sowing is looking pretty decent this time around. So maybe after the Kharif crop hits the market in September, we could see food inflation come off a bit.
Okay, so which leads me to my next question. All the talk of inflation and the possible cooling of inflation goes back to what's going to happen with interest rates. Even as we are awaiting what the U.S. Federal Reserve is going to do with the interest rates in the U.S., there's all eyes are on RBI. CRISIL expects an RBI rate cut in the month of October this year. Talk to us in terms of adjusting interest rates with the progression of inflation cooling.
So, my base case is that the first rate cut could come in February of 2025, not in the October meeting. So, two things to remember: highly unlikely that the RBI cuts before the U.S. Federal Reserve. But that said, the U.S. Federal Reserve could probably cut in the September policy meeting. So maybe when you go into the October meeting, you already have one rate cut from the Fed. But you also need to take into account the fact that the stance remains as withdrawal of accommodation even at this point in time. It's not impossible for the RBI to change the stance and cut at the same meeting, but given the growth remains relatively resilient, the RBI has brought down the 1Q FY25 growth numbers a bit, and probably it could be slightly lower than that looking at the high frequency indicators. But broadly, growth continues to be resilient. So I don't think they'll be in a hurry to cut rates. The earliest, in my view, could be December. Particularly, globally, you see at least two rate cuts, and inflation comes off. Domestic growth is also cooling off. Then you could see a December rate cut. But my base case still remains February 2025 could be the earliest that we are expecting a rate cut.
Okay, February 2025 is the date that you are working with. I'm asking this question simply because we've seen bank after bank, both public sector and private sector, hike the rates for fixed deposits recently, to the point where many were wondering, is it time, with all the volatility in the capital markets, is it time to start parking money in FDs? So in that sense, for all the viewers watching us, the investors, retail investors watching us, individual investors, small investors watching us, what would be your advice? Is it the right time to pivot and put your money into FDs at the high rates at which they are going? Because probably FDs won't remain for fixed deposits, the interest rates won't remain as high as they are at the moment.
You're right that if fixed deposit rates, have gone up, could go up a little more over the next few months, because the RBI has been particularly highlighting the wedge between the deposit growth and the credit growth. So the banks really need to pull up their socks on deposit growth. That's what the clear message from the RBI has been. So they're encouraging banks to expand their bank networks. FDs remain a good avenue for investment. I think the attraction of capital markets over the last few years has been, they've given double digits returns, and maybe even over 20% in some cases on a year-on-year basis. But FDs are definitely a safer bet. So I wouldn't advise people to cut down on the allocation to equities, entirely. But FDs at current rates do seem attractive.
Okay, at the moment they seem attractive, but what is the window that you're looking like? If people are thinking of investing in FDs and sort of taking money away from their mutual funds or other asset classes where they invested and then put it back into FDs, what is the time frame that they are working with over here? Is it till February 2025?
Uh, no, so actually it could take a little bit longer for the deposit rates to come off because as I was saying, there is this huge wedge between deposit growth and credit growth. So to that extent, the deposit rates could remain slightly higher even if the RBI cuts rates. So probably deposit rates may not come off in February 2025 even if the RBI cuts rates. Even in December or even October, deposit rates could remain slightly higher for longer. So the window of opportunity, I mean, it's probably longer than when the RBI starts cutting rates. But eventually, deposit rates will also come off if the RBI does say 50 to 75 basis points of rate cuts.
Right. So to deduce what you were trying to tell us, so basically, at least for the next 6 months, you're safe to find a good FD to park your money in.
That's right. Broadly, you can summarize it that way.
Okay, so 6 months is the time frame that we are looking at this stage. But a quick question in terms of is there are you seeing a particular time in the near future when food inflation could possibly start cooling, start coming under at least a manageable range?
As I was saying earlier, so when the kharif crop hits the market, probably that's when you could see the cooling of food inflation, begin. Vegetable prices also, I mean, vegetables is not entirely a kharif crop, but the key crops like onions, tomatoes, etc. There is a huge kharif component in that. So probably from September, October onwards is when you could start seeing food inflation coming off meaningfully.
Okay, September, October is when food inflation could start cooling, is the word coming in from Teresa John.